Everybody wants to know when the financial musical chairs will stop. And what they're really asking is, when will I not be able to get my wealth out of the markets? That's what we're going to talk about today, coming up. Welcome to ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies to not just help you through the financial crisis that we're coming up to or we're actually already executing, but also for strategies on the other side of it. And so it's really important because people always think that this can't happen there. But, you know, and that they would never let that happen when in reality, they have planned for this event. And so it's really important for us to understand why and how, because I'm always telling you that the wealth is going to stay in these markets in the next crisis. Well, let's look at why and how. Now, I'm just showing you one aspect because I only have a few slides. But I think that this is a significant one and is really representative of everything else that all the different areas in our system. Now, in part one, we talked about collateral. And we talked about the importance of quality collateral. Why does that quality matter? Well, it matters when you have a system that is based on an abundant, cheap, and almost free, easy way to create this collateral, but it's only used in one place. It's only used in the financial markets, which means it has a very limited base of buyer. What I personally like is good collateral, like gold, that has buyers across every single aspect of the global economy. But let me show you the plumbing of the financial system. And I think using emerging markets, including China in that, is a great place to look. Because all of that QE free money that's been sloshing around the globe and inflating all of those fiat money assets, well, that's really put the private corporations in advanced economies like the US in the perfect place to go in and fund the world. And so that's what they've done systemically. SIFIs, keep in mind, systemically important financial institutions. That's not just banks, that's any financial institutions. But today, because of all of this free money, private corporations are also participating in that. And as I showed you in the collateral, they're all completely interconnected with each other, whether it's a bank or a non-bank. But advanced economy, wealthy private corporations go in and give short-term funding to emerging markets. And that's called non-core funding, which means that it's foreign, which means that if a shock occurs, it comes in fast and it goes out fast. The funding dries up really fast. Because this is all short term, it's counting on either rolling over, constantly rolling over that debt, or being able to take on more debt. And what happens is as the funds are being loaned short term, that creates a credit boom in whatever other country you're loaning the money to. So local people can now borrow and spend, and that pushes up the asset prices, whether they're real estate or financial assets. It may even make the currency relatively stronger against other currencies, stronger against US dollars, for example, as they were borrowing a lot of money when the dollar was weaker. But the problem is, well, the good thing is, maybe, is that because these assets have inflated in value, you can borrow more against the same asset. And when there are limitations, because these corporations or these banks and these non-banks have access to international money, well, they go back to that market again and again and again. And so this just keeps going on and on and on with this debt bubble, this short-term debt bubble getting bigger and bigger and bigger. Well, let's say a shock occurs. Well, just as quickly as that money came in, if it's all short-term, what do they do when they can't roll it over or they can't borrow more? Can you see what the problem is? The whole system then has to freeze. And because there's not enough real good collateral in the system, because it's all garbage that's based upon demand with a very limited market, that is actually why your wealth remains in the market. It's kind of an interesting phenomenon. But this is also a new phenomenon that has happened. I mean, we had the prime money market that froze, that broke the buck. In other words, fell below $1 in 2008. That was short-term funding. So people got scared and they ran. So they knew this. And again, rather than changing behavior, they just changed the rules. You think Wall Street's not going to find the loopholes in the rules and then absolutely take advantage of them? Because what do? They privatize the gains. That's why you have the wealth. 10% of the wealth has shifted upward to the 1%. And they socialize the losses. We taxpayers are on the hook for all the losses from the financial crisis and all the money, all this QE money. We taxpayers are responsible for all of that. So I want to go and look at this a little bit closer, because you have to really understand what the real value of fiat is. I mean, people look at the stock market, and if they have ETFs and they're going, now the markets are inflating to new heights and all of that. Okay, so people go, "Ooh, that's great, that's wonderful. Oh, my money is working for me, and I'm making so much more money on this." Well, the problem is that the global capital flows to those emerging markets showing money in and out shows how quickly that can change. Look at this. And also, I'd like you to notice that 2007 pattern shift, where it used to be that GDP was greater than the money that was coming in, that was being borrowed. And once 2007 hit, well, guess what? All of that new QE money floated into those emerging markets in developing countries. And this is the kind of debt and the kind of this is the collateral that they're talking about. You can see how much it's risen, non-bank to non-bank, bank to bank, bank to non-bank, bank to bank. It doesn't matter where the crisis starts. It's going everywhere because they are all incestuously interconnected. It's just a fact. Look at this data. This is from the IMF report. So you're definitely going to want to take a link and see that. But remember how we talked about, well, if that currency gains value or gets stronger against the dollar, which is what had happened, then they take out a lot of debt in terms of dollars because it's cheaper. But guess what? The dollar is now appreciating faster. It's nearing some highs. I'll do something on that soon. And so it costs more to service that debt. That's why you have what? I think it's 20% of that we know of the corporations in China are zombie corporations where they don't even earn enough income before any costs or before any taxes. They don't earn enough income in a year to pay their interest expenses. Yet they're still in business. And there's a lot of that going on. See what I'm talking about? But what I'd like you to notice is that the share of the bank loans have declined, even as the share of banks to non-banks and non-banks to banks have exploded. This is what makes that all of the plumbing really, really vulnerable and also very, very fragile. And it also sets up a liquidity crunch on dollars, because these foreign corporations, these Chinese, a lot of them are Chinese corporations, they don't earn dollars, they earn yuan. But they have to convert those yuan into US dollars. And because of all of the QE and all of the bond buying and all of this extraordinary measures, which are actually now standard measures, not temporary anymore, what that really does is it sets up that liquidity crunch where they can't get those dollars, which means, guess what? Then they're going to default. Or maybe then they have to roll it into a new currency, into a local currency, perhaps, if they can do that. Well, they already didn't make enough money to even cover 1 year's of interest expense. So what's that going to do to them? And God forbid interest rates rise. This could be a huge reason why global central banks had to back down on raising rates. Well, the Federal Reserve was the one that was raising the rates. Nobody else would or could. And I'm going to talk about China, or rather Japan. I'm going to be doing something on Japan very soon, because I think, you know, if it's positive, that's where we're headed. I'm not sure that that's where we're headed, because this is just, it's way more than not sustainable. This is a crisis waiting to happen. And when this happens, it has a negative impact, on that collateral. Let me show you what that looks like. Because in this global slowdown, corporations are going to have a lot less income to service all of this debt that they've taken on. I mean, they didn't get rid of the debt, even though they had the opportunity to do so. But, yeah. Let me just show you what this looks like, because let's go back to 2007, 2008. And that lovely speculative toy derivatives, CDOs, collateralized debt obligations, MBS, I mean, it's a whole alphabet soup of made up products that have no value inside of them. They simply have a market value because Wall Street has agreed on what they will buy them for and what they will sell them for. But when the mortgages that they were based on, the CDO, collateralized debt obligation, the collateral was the promise to pay the mortgage. And when you had all of those people defaulting on the mortgage, well, that means that there really was no value at all in those CDOs, and you can see, although they are making a comeback now, but that's another video for another day, but you can see how much that dried up, which means you couldn't roll any of those over. And we certainly know what happened with the crisis. So the other big part of it, as I'm always talking about being incestuously interconnected, they did a great study on that, and you're looking at the different banks. So if you have Bank A, Bank B, Bank C, Bank D, and they're all holding different fiat money assets, when a shock occurs and Bank A is forced to liquidate some of their holdings and maybe even default on a loan that they had to Bank B, that forces Bank B to sell off their holdings and perhaps default to Bank C, who goes through that same process, the same thing as D, which is why the U.S. government, the taxpayers, bailed out AIG. Because if AIG had not paid off those derivatives at 100%, mind you, they had zero market value, but they paid off Goldman Sachs, JP Morgan, Wells Fargo, all those big players, Citigroup, all those big players got paid off thanks to our tax dollars at 100% because of that contagion. Because if AIG hadn't paid those trades, then Goldman wouldn't have been able to, and JP Morgan wouldn't have been able to, and it'd be a whole domino effect. And in fact, you know, what are the two key players that you might remember from 2008? Bear Stearns and Lehman. Interesting how close their stocks really kind of the price action in their stocks worked with each other. But Bear Stearns, I remember I was in Italy when Bear Stearns went down. You remember that, Megan? I was sitting there watching the TV and I'm like, oh my God, I can't believe I'm here when that's happening. But they had these two funds and they had great names on them, you know, triple leverage, AAA rated, blah, blah, blah. All this, you got to be aware of the names because it's usually just the opposite. And they kept telling their investors, don't worry, don't worry, don't worry. Behind closed doors, they were saying something else. But I think one was like 6 billion, the other was like 6.2 billion. As you can see from these two graphs, almost overnight, and actually overnight, bam, they went to zero. There is effectively no value left. And with Lehman, well, because of that short-term funding, in other words, in money market accounts, there were a lot of short-term Lehman bonds. And Lehman went under. So guess what happened to all those bonds? So the value of that collateral when these loans were taken out was up here. So they took out this loan even if the loan was more or even if it was a little bit less. When the value of that collateral collapsed to zero, you still had that loan. See the problem? And the plumbing is really, really clogged with a whole lot of grease and garbage. A whole lot of grease and garbage. So in 2007, 2008, when the plumbing froze and clogged up, and some of you out there, and you know, honestly, if you had this experience, we would really appreciate it if you would share it, you know, in the comments below so other people can see it, because there were a lot of people whose wealth evaporated into those markets, never to recoup again, never to come back, even with all the reflation that they've done since. So when the dust settled, 5 trillion in pension money. Shockarooski. Now it's going to be worse because a lot of the pension plans, what have they been doing? The banks are getting out of things, and guess who they're selling it to? The pension plans. Good way to secure a retirement. You know, so this is what it looks like when liquidity dies. And it runs through the whole system, which is why if your wealth is in there, you ain't getting it out. Sorry, you're not getting it out. Now, a lot of times people don't have the option. If you're in a 403B, you can't take those funds out. Or maybe you think that you want to participate in the melt up. Maybe you do. I mean, that's up to you. Everybody's got to do what they're comfortable with. Then I'm going to tell you that for me, you want to have your fiat, whatever you keep in the fiat markets, you want to have that properly diversified and anchored. So that if that all goes away or if you lose all access to it, not a big deal. You make it up over here. That's a properly diversified portfolio. Now, the question that was asked, and I really love it when you guys ask me questions, because then it goes, well, maybe I haven't explained this, and it gives me an opportunity to do this. So follow those links. There are different places where you can follow or look at to see what's happening with liquidity. You guys know I'm always showing you the charts, and you can see the volume on the exchanges going down and down, even as the stocks are going up. Well, that's pretty easy to do with derivatives. But that is one place you want to look at. And I love the charts and graphs, and you know, because I use them all the time. So over at the Fred, there's a whole bunch of links, and I gave you the link to the main page so you can go in and look at. But the keyword to search is going to be tightening. Even if you're Googling, you want to know about tightening, because that means there's not as much money available. Okay, that's what the tightening is. And global liquidity. The biz tracks that on a constant basis, and what that really goes down to is on the banks and what they are taking in or loaning out, and they do it both country by country, which is a little complicated to follow, but they also do a great, they do a lot of reports on it that have a lot of graphs. I personally like graphs. I actually love my spreadsheets too, but I love graphs because you can get the whole story at a glance. Again, the volume on the exchange, is it going up? Is it going down? What's going on? Are there more people participating, more traders participating, or fewer? So it gives you a lot of insight into the real liquidity in the markets. And of course, Yardeni, and you see me use a lot of his graphs, he does fantastic reports all the time. They're all graphs. So you would want to look at global liquidity, and you would also want to look at central bank balance sheets, because you can see what QE looks like. Lots of money printing, lots of taking garbage onto their balance sheets, and new money creation. And you can see what QT looks like, where they were allowing, well, the Fed was anyway, allowing their balance sheet to run off, and in some other countries they just weren't buying as much. Well, that's all changed now, but this goes through March, so it'll be interesting. But Yardeni publishes these all the time, constantly publishing these different groups. So definitely a place that I go all the time, and you've got the links to them. So you can, these are places where you can visit to see what's happening in liquidity. But there are places that you can't see. And so that's what the rest of the work is about, to help you understand where we are, because I think we're about to get a crap load of central bank created liquidity. And here's the problem with that. It doesn't really work anymore. It's like pushing on a string. So what happens when the liquidity, you know, the central bank injections, what happens when they don't work? Because they're about to do, like I said, a crap load. When we know all the ones that they've done now, most of that inflation has gone into fiat money assets. So that's why, yeah, we're probably, when they start doing that heavy duty again, yeah, we're in melt up. But again, are there buyers on the other side when you want to get out? We've talked about the derivative, the ETF derivatives, and how they've contained their liquidity, because they actually don't, if you want to liquidate, they don't have to liquidate. They can give the shares to the bank, and then it's the bank's issue. And as long as they've got enough, you know, savings or reserves, or they have the ability to borrow, okay, they can keep that covered. But at some point, if it gets big enough, they won't be able to cover it up. So what happens when this, not real, but this fake liquidity doesn't work anymore? Well, that's what the hyperinflation is really going to show us. And what the central banks know, because what happens, like you saw in 2008, that collateral loses all of its value. There's no liquidity to it, no buyers for it. And so what the central bankers have been doing significantly since 2011, I'm pretty sure, is there has been a rush of gold repatriation. In other words, governments, central banks that were holding their gold offshore are calling it home. Send it to me. I want to hold it myself. You think they might know something that you and I don't? You think they might be preparing for the system to freeze for the next crisis? Because they don't have any more money printing tools to cover this up. They're out of it. They're out of it. Look at the work. Follow the links. Maybe you'll think differently, but I don't think differently, because I'm looking at the hard data underneath it. There are no tools for this next crisis. This next crisis is going to make 2008 look like chump change. Mark my words on that one. I'll put my neck on the line. But what they really know, and what we should all know, if you don't hold it, you don't own it. So they're bringing it home so they can own it. Because if it's at the Federal Reserve in New York, or if it's at the Bank of England in London, and the crisis hits, Possession is 9/10 of the law, maybe even 10/10. That's why they're bringing it home. And that's really what the message is. They know there's no liquidity in these markets, but what they're creating to make it appear like everything's okay. But the reality is, it's not okay. The plumbing is clogged. The plumbing is clogged. And the pipes to this plumbing will burst. And that burst could happen anytime. So when do you want to know and when do you want to be ready? Because if it bursts, you have no other options. It's over. So you want to get ready before. I've been working hard on it since 2002. I've been building my farm so that I could make sure to be able to feed, well, not just us, but lots of people since 2010. Thank goodness, because there is no way that I would have been able to do what I've done even starting now before the next crisis. There just wouldn't be enough time. I'm sure of that. I'm sure of that. So I suggest, if you haven't started, get a move on. This is the time to buy it. And hey, with them suppressing the price of gold and getting everybody, look over here at the stock market at new highs, whoop-de-doo. Things are so awesome. While over here, they're accumulating. They're calling their gold home. Take a page from their book. Make sure you possess the gold. We just did one on where to hold. Go ahead and look at that, but be creative with it. And remember, shields are made of metal, and financial shields are made of monetary gold. And actually gold in any form is monetary, so is silver. That's what they're made of. In any form. I'm good with it. In any form. Although coins are easier and there's all sorts of reasons for that. So that's it for today, and I hope that you got a lot out of this. And I'm going to ask you, part 1 and part 2, I think that these are the most important pieces that I've done in a really long time. And they need to be shared because everybody needs to know what I'm showing you here. Please, please, please share them. If you have any questions or comments, call us. We like that personal contact. We don't want to do away with that. It's the way we can help you the best. And we're all paying attention, and we're all here to be of service. So until next time, please be safe out there. Bye-bye.